Welcome traders to supply demand. Or do you call them order blocks, sponsored candles? I do not care, guys. It is the same concept. We are going to call them supply demand in our Diversifix community, but I will not judge you if you will write down order blocks or any other names. Important for us is the concept behind this name. Now, let's get it started. We will start with the supply zone. Now, a supply zone is a thing which we would like to determine within a downtrend. So, when price is moving to the downside, you will see price breaking structure to the downside. This is how it will be confirmed. Now, what you will see at the creation of a lower high, so we got this one here. This is our lower high. We got a lower low, which will be broken by the movement at the lower high. So what am I talking? Well, basically, what you will always see after a break of structure, if you analyze who was responsible for that break of structure, you will see a candle which is moving to the upside, and afterwards we will see a strong candle to the downside, and this strong candle will break the previous lower low. In addition, the market will create a gap. Now you will say, what gap am I talking about? Well, I mean the gap here. Let me just mark the next candle so that it will make it more clearly to you. Let's use it here red as well. So you see here the next candle which is created here. So this is how the down movement works. Price is moving to the downside, and you will see that there is a gap between this wick over here and this wick over here. So I call this a gap, or another word for it is market inefficiency. Market inefficiency sounds for me a much better name. Gap is easier for us to understand because price has created here a gap. So these two wicks are not meeting with each other. And what does that tell us? So this is super important. This gap tells us that the sellers and buyers didn't have a fair chance to come together. So that means that the price dropped way too strongly to the downside, that not everybody had the chance to jump on this trade. Okay, so you need to understand the big institutions, okay, they know exactly what they're doing over here, and they are trying always to get the maximum out of it. And whenever there is a gap like this or market inefficiency, we know exactly that they are highly interested in bringing the price very soon to the upside in order to fill that gap and in order to get a fair chance to get involved into this trade. Okay, now sounds a little bit complicated on the first view, but it's not, because what we need to understand is that this buy candle over here, this bullish candle over here, was created from the same institution who brought the price at the same time that strongly to the downside. Now that means that this institution at this point over here, so when the market price is at this area over here, so let's put this price level here. So when the price is here, this institution is in positive. Okay, if you sum everything up, the institution will be positive, but they have at the same time a negative position. Which one? Exactly, the buying position. I would say, why does this institution still have the buying position open? Well, actually, they have this buying position still opened, and at the same time the bearish positions as well. So they're buying and selling at the same time. The reason for that is because they don't want to take losses. So they do not trade like we are trading. The way on how we retail traders are trading is the complete different approach. We need to use stop losses. Big institutions do not use stop losses because they can hold this whole drawdown. Okay, so they have massive drawdown on their position, but for them that's not relevant because they on the same time they have big short positions, right? So they are in profit. But what they're about to do is actually they broke structure to signalize to the other institutions, hey guys, this market is right now dropping because I'm shorting it. So I want to see the price dropping to the downside. They took the chance from the other institutions to get involved into the short position. Why? Because price dropped way too much to the downside. This is what the other institutions can see when they're just looking at the charts. They see, oh, okay. So they would like to join this trend as well, because otherwise they could have bring the price like that to the upside. And this is not the idea of on how the institutions are communicating with each other. No, they see, okay, that one institutions broke structure. He would like to bring the price to the downside. He left this gap for us so that we know, okay, price will come very soon to the upside and we can get involved into that trade as well. And the thing is right now, this is why they do not close their buying position, because they know they will bring the price to the upside, so they will have the chance at this supply zone, so we will call them supply zone. They will close exactly over here, so not sure where exactly, not sure if it will be exactly at the open price, okay, probably here or at the middle or even at the top, okay. So no matter at what kind of level over here they are going to close it, of course, the higher the close will be, the better for them, because probably they will even bank profit out of this position, depending on where they've been buying it. Because if you look this movement on the lower time frame, it will look something like this. Okay, it will be an uptrend. Okay, to signalize the retail traders that the market will potentially go like this, but in fact, it just generated liquidity here below it, which they have been attacking with this strong sell to the downside. Okay, and now we don't know exactly, if you look on this trend, where they exactly bought the price, if they bought here or if they bought here and here and here, and then they will close it here. It's not clear, because when the price will reverse right now back here, at some point they will close it, and at that point when they are going to close it, they will be adding additionally shorts, plus other institutions will join this market as well, and they will bring it afterwards even lower to the downside. So this is actually the theory behind the supply and demand, and this works right now for the demand zone the same way like it works for the supply zone. So this is the real meaning of this gap. So it is called also fair value gap. I'm not sure about it. I just call it here in this case, for me, this is an imbalance. Okay, this is an imbalance. So the balance between prices is not given. It is an inefficiency in price, and it's in gap at the same time. So you have right now a ton of words for that will explain you this kind of concept, and the price will more than likely go after it broke structures. It's super important that we broke structure, because this is, like I explained to you already, this is how they communicate. Okay, price will definitely go lower, and our target will be then at least this zone over here, and probably we will go even lower, breaking structure again, and we will repeat this game again and again. So the idea is, when the price will come here, that you can go here, put your stop loss a little bit above. Okay, always put it a little bit above it. You can also put your entry a little bit below, okay, because price sometimes will not completely touch it. Okay, it will depend on how the institutions will act, because sometimes they have so much pressure within the market that they will just bring it from here all the way to the downside. So they have already too much liquidity within the market that they are not interested in bringing the price that much. And then you put your target exactly over here. That's basically it. That's one option, okay, to put it like this. That's your first option. Second option is to put it exactly at the middle of it. Okay, with putting it on the middle, this is just a mathematical thing. You will more than likely expect the price to tap into this zone over here or into this zone over there, right? And this is why our approach will be, okay, you could put your price here, or risk half of your risk here and half of your risk here, and you will get in. If you sum it up, you will have a better risk reward. Okay, sometimes it's just better to just put it like this, because if you will see, okay, a price more than likely will tap higher into that zone, then put it like this. If you have the feeling for it, okay, no, price will not tap that much to it because price is so strong in a downtrend, I do not expect the price will go that much to the upside, then you will put it over here. But for us, this is not always important, because we will get very great risk rewards also if we will put it over here. It will depend on the time frame that you will use it, because you can refine these zones on the lower time frame. So let me just explain to you over here. So demand zone, the same thing. I always recommend you to put really the take profit at the next structural point, because this is here then your new bearish range from a structural point. So you expect the price to come up higher, and the supply zone will then actually confirm your trade and put it here, because from that zone price could potentially now break it, and it will from here reverse completely to the upside. So you will miss out on many trades if you will not close it exactly at the structural point. What you can also do is to put it a little bit below, because there is again liquidity located and the price could then reverse. Okay, that's also another important thing. Additionally, right now, let's go into the theory of the refinement. So like I explained to you already, price here more than likely will look like it is in downtrend. So price came from the downside, right? And then when it comes here, it will move something like this to the downside, and then at some point it will go, oh sorry, it has different options on how the liquidity here is generated, more in the liquidity section, because it could be a range, and then price will short it down, okay, and then this candle will be created, and then from here it will move like this to the upside. And your refinement in this case will be to not use this whole candle, okay, because if you will look on this movement here, you will see price is moving like this and then moving up higher, and then this thing over here will be your refinement candle instead of using this whole thing. So hopefully that makes right now sense. Let me just repeat it once again for you. So we got demand zone. Price has, like I explained to you, multiple options on how it can look like. More than likely it will be a short candle. Probably it will be here again something like a bullish structure, and then price will move lower, and this movement to the downside, this whole range will be this zone here, and it will look like this. Okay, this movement can look like this, and then this strong push up will work out. And we would have been mapping then on the 1 hour time frame, for example, or on the 4 hour time frame, we will map out this whole thing to be the demand zone, but we can refine it to the last movement to the downside. Okay, so you should always understand that the theory about a supply and a demand is, so on a demand zone, the last down movement candle before the strong up movement occurs, on the supply zone, the last up move candle before the strong movement to the downside will occur. Okay, that's the exact rules of it. And what you would like to see is that the price will definitely break some structure, because if it will not break structure, then it will just push the price till that structural range, okay? And if it will put only till the structural range, then you can still expect the opposite direction to occur, and in the most of the times it will do it like that, because this is how they trigger the people, by breaking minor structure previously before the real movement will occur. Okay, hopefully that makes sense for you. So this is just a theory right now behind the supply demand. And look at this, guys. This is how you can then refine it, because then you will put your demand here. You put your demand then here, and it will make your demand zone automatically much better. So your risk reward will be increased in insane. So it is an insane increase in risk reward in comparison it's right now to the other ones. Okay, so normally you would have been using right now this whole range over here. Okay, it's a 3 and that's a 7.6, and you don't need to use that mathematical thing. So you look for logical things, right? Because you know, okay, on the lower time frames you have it anyways, right? You have anyways your confirmation for it. So let's see in the next video, guys.